Hi, everybody. Thanks for joining me. My name is Matt Frankel. I am a certified financial planner and stock analyst. Today, we're going to look at one of my favorite up and coming financial technology or fintech companies called Marqeta. If you like what you hear, subscribe to my YouTube channel and feel free to share this video on your social media with your friends, anyone you think you would benefit from some good stock ideas, good financial advice, and other investing topics. So Marqeta is kind of a little known, kind of like behind the scenes company, although their business is a lot bigger than you might think. Marqeta has kind of transformed the payment cards industry for businesses all over the world. So it's historically been impractical for businesses to issue their own customized payment cards or customized payment solutions. Marqeta aims to kind of democratize the process, and it's been very successful. Its customers are businesses of all sizes. Just to name a few example, Affirm, DoorDash, Square all use Marqeta's solutions. If you ever order on Instacart, Marqeta is what allows your Instacart shopper to pay for groceries on your behalf, even though they don't physically have your credit card. So really customizable, innovative solutions. They support debit cards, credit cards, prepaid credit cards. At the end of 2021, there were about a half billion payment cards that use Marqeta's technology, and they combined to process about $111 billion worth of payment volume last year alone. So Marqeta makes money from swipe fees, as most companies involved in payment processing do. They get about 0.2% of the average transaction. That may not sound like a lot, but when you're talking about $111 billion of volume last year, these small little fees can add up to quite a bit of money. So how can they grow from here? Well, because it's kind of a percentage-based business model, Marqeta's business, first of all, naturally grows with its customers. If one of its customers doubles its revenue through Marqeta's cards, then or doubles the payment volume it's seeing through Marqeta's card, then Marqeta's revenue will naturally double, even though the company didn't really do anything to grow its business. It grows naturally with the customers that use its technology. Payment cards are becoming a lot more of a necessity for a lot of businesses. More Americans are using mobile wallets than ever before. About 71% of Americans use mobile wallets now. That's up significantly from just a few years ago. And Marqueta's kind of just starting to tap into this opportunity. It's estimated that there's about $7 trillion of card payment volume that takes place in the US alone on an annual basis, about $30 trillion globally. So Marqeta has less than well under 1% of the global market share and not that much more than that of the US when it comes to card payment volume. It's constantly introducing new products. It's forming new partnerships. It just formed a new partnership with Western Union in Europe for its payment solutions, and the results are impressive. Its revenue is still growing very fast despite the global kind of slowdown. Revenue was up 53% year over year in the second quarter. It's still losing money, but its loss margins are getting better. It lost 50 or $45 million in the second quarter. May sound like a ton of money, which it kind of is to in a lot of ways. But the company has about $1.7 billion of cash and equivalents on its balance sheet, so it can afford to take losses like that for a while it's figuring it. Well, as long as its growth is heading in the right direction. Um, it's not even profitable on an adjusted basis, but like I said, the margins are getting better. It expects to grow revenue by another about 37% in the third quarter, year over year. A little bit of a slowdown, but that's to be expected. One of the biggest risks of this business is that the payment volume is likely to be very cyclical. Um, People spend less money in uncertain times, in tough economic times, and when they can't afford to spend a lot of money, inflationary times. So it's likely to be very cyclical, the payment volume. And I mentioned it's not profitable yet. We're starting to see a path to profitability form, but we want to see some kind of green ink on its financial statements within the next year or two, at least on an adjusted basis. So the stock is down significantly. It's down about 80% from the highs it reached in November of last year. Um, it's just not a great environment for high growth stocks that are not yet profitable. It's a rising rate environment, which puts pressure on growth stocks, and investors really want to see some profitability in this kind of environment. If Marqeta keeps growing its revenue at 30 to 50% year over year, profitability will take care of itself down the road. This is a high gross margin business. Um, its market cap is only about $4.3 billion. And I mentioned that about $1.7 billion of cash and investments are on its balance sheet right now. So I would definitely put this more in the speculative basket. It's toward the top of my watch list. It looks like a value slash growth stock at the current price just because of how much it's come down, but it still trades at a pretty high multiple of sales. The growth is really impressive, and this is one that I'm going to keep watching. Not quite ready to pull the trigger on, but definitely an impressive business that has got my attention. This video is sponsored by the Motley Fool. Check out the link in the description to receive the top 10 best stocks to buy now, or visit fool.com/Frankel.